If you are over 60 years old and you have not been paying attention to what Warren Buffett is doing with his money right now, you need to stop everything and listen. Because the greatest investor of all time, a man who is 94 years old and has more experience protecting wealth than anyone alive, is making moves that could directly impact your retirement. And what he is doing might surprise you. He is not buying stocks. He is selling them. He is not chasing returns. He is hoarding cash. And if you understand why, it could be the difference between a comfortable retirement and running out of money. Let me be very clear about something from the start. This is not about doom and gloom. This is not about predicting a crash. This is about learning from someone who has spent 70 years figuring out how to protect and grow wealth through every kind of market imaginable. Warren Buffett has seen 14 major market crashes. He has navigated recessions, banking crises, wars, pandemics, and everything in between. And right now, at 94 years old, he is making very specific choices with his money that every person over 60 should understand. Here is the situation we are facing. If you are 60 or older, you are in a very different position than younger investors. You do not have 30 or 40 years to recover from a major market downturn. If your portfolio drops 50%, you cannot just wait it out. You might need that money for living expenses, for healthcare, for unexpected emergencies. Time is no longer your greatest ally, which means the way you invest, the risks you take, and the strategies you follow need to be different. And that is exactly why what Warren Buffett is doing right now matters so much to you. Because Buffett, despite being worth over $130 billion, is investing like someone who cannot afford to lose. He is prioritizing capital preservation over capital appreciation. He is choosing safety over growth. And there is a very important reason for that. Let me walk you through exactly what Buffett has been doing over the past year. Because the moves he is making are not random. They tell a very clear story. First, Berkshire Hathaway, his company, is now sitting on over $325 billion in cash and short-term treasury bills. That is the largest cash position in the company's entire history. To put that in perspective, that is more cash than the total value of companies like Nike, Starbucks, or Goldman Sachs. It is a staggering amount of money just sitting there, earning 5% in treasury bills. Second, Buffett has been selling stocks aggressively. Most notably, he sold over half of his Apple position. Apple was his favorite stock. He called it the best business in the world. He owned nearly 900 million shares at one point. And then he sold over $50 billion worth. He has also been trimming other positions. Quarter after quarter, the 13F filings show more selling than buying. Third, and this is crucial, Buffett is not deploying that cash into new investments. Despite having more money available than ever before, he is choosing to sit on the sidelines. He is earning 5% in treasury bills rather than putting that money to work in the stock market. Now ask yourself this question. Why would the greatest investor of all time, a man who has made his fortune by buying stocks, suddenly become so cautious? Why would he choose guaranteed 5% returns over the potential for higher gains in the stock market? The answer has profound implications for anyone approaching or already in retirement. Let me break down the reasons behind Buffett's moves and explain why each one matters for your retirement. The first reason is valuation. Stock prices right now are expensive by almost any historical measure. The S&P 500 is trading at valuations we have not seen since the dot-com bubble of the late 1990s. The Shiller P/E ratio, which compares stock prices to 10 years of inflation-adjusted earnings, is at levels that have historically preceded poor returns. When Buffett bought Apple in 2016, he paid around 10 to 12 times earnings. Today, Apple trades at nearly 30 times earnings. The business is still good, but the price has tripled relative to earnings. And Buffett has always said that price is what you pay, value is what you get. At these prices, the margin of safety that Buffett demands simply is not there. For someone in retirement, this matters enormously. If you are buying stocks at expensive valuations, you are taking on more risk with less potential reward. The math does not favor you. And unlike a 30-year-old who can wait out a decade of poor returns, you might need that money much sooner. The second reason is interest rates. For the first time in over 15 years, you can earn real returns on safe investments. Treasury bills are paying over 5%. Certificates of deposit are offering 4 to 5%. Money market funds are yielding similar amounts. This changes everything. During the era of zero interest rates, retirees were forced into stocks because there was no other way to generate income. Cash earned nothing. Bonds paid almost nothing. The only way to get any kind of return was to take risk in the stock market. That pushed a lot of people into investments that were not appropriate for their situation. But now you have options. You can earn 5% on your money with zero risk. That is a guaranteed return backed by the full faith and credit of the United States government. And Buffett, with all his expertise and resources, is choosing that option over stocks. He is parking over $300 billion in treasury bills rather than investing it in the market. For a retiree, this is a gift. You can generate meaningful income without taking stock market risk. If you have $1 million in retirement savings, you can earn $50,000 per year in treasury bills without any risk of losing principal. That was not possible just 3 years ago. The third reason is uncertainty. Look around at the world right now. There is geopolitical tension everywhere. Trade relationships are being restructured. Government debt levels are at historic highs. There are questions about the sustainability of Social Security and Medicare. Artificial intelligence is disrupting industries in ways we do not fully understand. Inflation, while cooling, remains higher than it was for decades. In this kind of environment, Buffett is choosing caution. He is not trying to predict what will happen. He has always said he has no ability to forecast short-term market movements, but he is acknowledging that uncertainty is elevated and positioning accordingly. For retirees, uncertainty is particularly dangerous. A young person can ride out bad outcomes because they have time to recover. You may not have that luxury. If things go wrong at the wrong time, it could permanently impair your retirement lifestyle. Buffett's caution is a signal that now might not be the time to be taking excessive risk. The fourth reason is taxes. This one is often overlooked, but it is very important. Buffett explicitly mentioned in his shareholder letter that he believes tax rates are likely to increase in the future. The United States government is running deficits of around $2 trillion per year. The national debt is over $34 trillion. At some point, revenue needs to increase. By selling Apple and realizing gains now, Buffett locked in the current 21% corporate tax rate. If tax rates go up to 25 or 28% in the future, he saved billions by acting now. For retirees, this has implications too. If you have large unrealized capital gains in your portfolio, it might be worth considering whether to realize some of those gains at current tax rates. If income tax rates or capital gains rates increase in the future, you could end up paying more by waiting. This is something worth discussing with a tax professional. Now let me give you the historical context because Buffett has acted this way before, and the outcomes are instructive. In 1969, Buffett closed his investment partnership and returned money to investors. He said he could not find bargains. People thought he was being overly cautious. Over the next 5 years, the market fell nearly 50%. Buffett's caution protected his investors. In the late 1990s, Buffett refused to participate in the technology bubble. He was mocked as a dinosaur who did not understand the new economy. Then the Nasdaq crashed 80%, and those who followed the crowd lost everything. Buffett's caution was vindicated. In 2007, Buffett was holding large amounts of cash while others were fully invested. When the financial crisis hit in 2008, he had the resources to make legendary investments in Goldman Sachs and General Electric at incredibly favorable terms. His patience and caution created opportunity. The pattern is consistent. When Buffett becomes cautious, when he raises cash, when he refuses to pay high prices, it often precedes difficult times in the market. He is not predicting crashes. He is acknowledging that the odds do not favor aggressive investing at certain moments. And right now appears to be one of those moments. Now here is something else worth considering. Buffett is 94 years old. He is thinking about legacy, about protecting what he has built, about making sure Berkshire Hathaway survives and thrives long after he is gone. His time horizon has shortened, just like yours has if you're over 60. When you are young, you can take big risks because you have decades to recover from mistakes. But as you age, capital preservation becomes more important than capital appreciation. The money you have accumulated over a lifetime of work needs to last the rest of your life. Losing it is not an option. Buffett understands this intuitively, and his current positioning reflects it. He is not trying to hit home runs anymore. He is trying to protect what he has while generating reasonable returns. That is exactly the mindset every person approaching retirement should adopt. There is also a psychological element here that we should discuss. Market volatility is much harder to handle when you are older. When you are 30 and your portfolio drops 30%, you might even see it as an opportunity to buy more. But when you are 65 and that same drop represents hundreds of thousands of dollars that you were counting on for retirement, the emotional impact is completely different. Buffett has always emphasized the importance of being able to sleep well at night. Your investment strategy should give you peace of mind, not anxiety. If checking your portfolio makes you nervous, if market drops cause you to panic, that is a sign your portfolio is too aggressive for your situation. By holding record amounts of cash and trimming stock positions, Buffett has created a portfolio that can weather any storm. He will not be forced to sell at the wrong time. He will not panic if markets crash. He has the resources and the positioning to be patient. That peace of mind is worth a lot, both financially and emotionally. So what does this mean for you if you are over 60? Let me give you specific, practical guidance based on what we can learn from Buffett's approach. First, evaluate your current asset allocation honestly. How much of your portfolio is in stocks versus bonds versus cash? Many retirees are overexposed to equities because that was the only way to earn returns during the zero interest rate era. But the environment has changed. You can now earn meaningful returns on safe investments. Consider whether your current allocation is appropriate for your situation. Can you afford a 30 or 40% decline in your portfolio? How would that affect your retirement plans? If the thought of losing a third of your savings keeps you up at night, you probably have too much risk in your portfolio. Second, think seriously about increasing your allocation to treasury bills and other safe investments. Buffett is earning 5% on over $300 billion. He is choosing that guaranteed return over the uncertainty of stocks. You can do the same thing. For a retiree, having 2 to 3 years of living expenses in safe, liquid investments provides enormous peace of mind. It means you do not have to sell stocks during a downturn to pay your bills. It means you can weather volatility without panic. And right now, you are being paid handsomely to hold that safety cushion. Third, if you own individual stocks with large gains, consider whether to take some profits. This is not about timing the market. This is about prudent risk management. If a single stock has grown to represent 20 or 30% of your portfolio, that is concentration risk. Even Buffett, who loved Apple, decided that 50% concentration was too much. Taking some profits locks in your gains, reduces your risk, and potentially saves you money on taxes if rates increase in the future. You do not have to sell everything. But trimming positions that have grown outsized can make your portfolio more resilient. Fourth, be very careful about reaching for yield. When interest rates were zero, many retirees bought high-yield bonds, dividend stocks, or other risky assets to generate income. But now you do not have to do that. You can get 5% from Treasury bills with no risk. High-yield bonds can lose significant value if the economy weakens. Dividend stocks can cut their dividends and see their prices fall. These are not risk-free income sources. If you can get similar yields from safe investments, why take the extra risk? Fifth, make sure you have adequate cash reserves for emergencies. This is different from your investment portfolio. This is money that you can access immediately if something unexpected happens. Medical expenses, home repairs, helping a family member. Life throws curveballs. Buffett has always emphasized the importance of never being forced to sell at the wrong time. Having adequate cash reserves ensures you will never have to liquidate investments during a market downturn to cover an emergency. That flexibility is worth a lot. Sixth, consider the sequence of returns risk. This is something most people do not think about, but it is critical for retirees. The order in which you experience returns matters enormously when you are withdrawing money. If you retire and immediately experience a major market decline, you could be forced to sell investments at low prices to fund your living expenses. This locks in losses and depletes your portfolio faster. Even if the market recovers later, the damage is done. Your portfolio may never recover because you sold shares at the worst possible time. Having a buffer of safe investments protects you from this sequence of returns risk. You can draw from your safe holdings during downturns and let your equity investments recover. This is exactly the kind of thinking that Buffett's current positioning reflects. Seventh, do not panic and do not make sudden dramatic changes. I am not telling you to sell all your stocks tomorrow and hide under your mattress. That would be foolish. Stocks remain an important part of a retirement portfolio for growth and inflation protection. What I am saying is that Buffett's behavior should prompt you to review your own situation. Are you taking appropriate risk for your age and circumstances? Are you taking advantage of the higher yields now available on safe investments? Are you prepared for the possibility of a market downturn? Eighth, think about your income needs versus your growth needs. At 60 or older, your investment priorities should be shifting. You are likely drawing down your portfolio rather than building it up. That means income and capital preservation become more important than maximum growth. Buffett's portfolio reflects this kind of thinking. He is not swinging for the fences. He is protecting capital and earning steady returns. He can afford to be patient, and so should you. Ninth, understand the difference between your needs and your wants. There is a level of wealth you need to maintain your lifestyle through retirement. Food, housing, healthcare, basic transportation. These are non-negotiable. And then there is additional wealth that funds discretionary spending, vacations, gifts to grandchildren, hobbies, luxuries. Your needs should be funded by safe, reliable investments. Treasury bills, high-quality bonds, and stable dividend payers. Your wants can be funded by growth investments that might fluctuate in value. This mental framework helps you think about risk appropriately. You should never gamble with money you need. Buffett's approach reflects this same thinking. He has more than enough money for any conceivable need. Everything beyond that is gravy. So he can afford to be conservative with the core portfolio while still maintaining exposure to growth through his remaining stock positions. 10th, do not forget about inflation. While I have emphasized the importance of safe investments, I also need to acknowledge that hiding entirely in cash is not a solution. Inflation erodes purchasing power over time. If you live another 20 or 30 years, prices could double or triple. This is why maintaining some equity exposure is still important even for retirees. Stocks provide growth that can outpace inflation over long periods. Buffett still owns hundreds of billions of dollars in stocks despite his cautious stance. He has not abandoned equities entirely. He has simply reduced exposure and rebalanced towards safety. The right answer for most retirees is a balanced approach. Enough in safe investments to cover several years of expenses and provide peace of mind. enough in equities to provide growth and inflation protection over the longer term. The exact percentages depend on your specific situation, your risk tolerance, and your income needs. Let me also address something important. Some people will say that Buffett's situation is completely different from yours. He has $130 billion. He runs a massive conglomerate. His time horizon is different. His tax situation is different. All of that is true, but the principles behind his actions are universal. Buy quality assets at reasonable prices. Do not overpay. Have cash available for opportunities and emergencies. Be patient. Do not take risks you do not need to take. Protect your capital. These principles apply whether you have $100 million or $100,000. The scale is different, but the wisdom is the same. Here is what I want you to take away from all of this. Warren Buffett, at 94 years old, with more money than he could ever spend, is investing conservatively. He is prioritizing safety over growth. He is holding record amounts of cash. He is selling stocks rather than buying them. He is earning 5% in treasury bills rather than chasing returns. If that approach makes sense for the greatest investor who ever lived, it might make sense for you too. Especially if you are over 60. Especially if you are approaching or in retirement. Especially if you cannot afford to see your portfolio cut in half. This does not mean you should live in fear. It does not mean the market is going to crash tomorrow. It does not mean you should sell everything and hide. What it means is that you should be thoughtful about risk. You should take advantage of the higher yields available on safe investments. You should make sure your portfolio is appropriate for your stage of life. The next few years could bring anything. The market could keep going up. It could crash. It could go sideways. Nobody knows. But what you can control is how much risk you are taking. What you can control is whether you have adequate reserves. What you can control is whether you are positioned to weather whatever comes. Warren Buffett has spent 70 years figuring out how to protect and grow wealth through every kind of market. Right now, he is choosing caution. He is choosing safety. He is choosing patience. That tells you something about the environment we are in. Pay attention to what the smart money is doing, not to blindly copy it, but to learn from it. Because when Warren Buffett changes his behavior this dramatically, when he raises cash to record levels, when he sells his favorite stock by the billions, it usually means something. And if you are over 60 with your retirement on the line, that something is worth understanding. Review your portfolio. Check your allocation. Make sure you have adequate safe reserves. Consider taking some profits if you have concentrated positions. And remember that at this stage of life, not losing money is more important than making money. Buffett understands that. And now you do too.